Good morning. Today is Wednesday, February 22nd, 2023. Thank you for joining us. We're going to recap what happened yesterday and really what's happened the last 3 weeks since the market peaked on February 2nd. So we're going to jump into that. We're going to talk a little bit about the Fed minutes, which are coming out later today. Have a couple earnings and some corporate announcements for you as well. So that's the agenda for today. I will be out tomorrow and Friday, although I might be able to do the notes for tomorrow. Yeah, I'm going to Las Vegas to run the rock and roll half marathon. So I've been training for a while, so I'm excited for it. Feeling a little bit under the weather today, but just push through, right?
Yeah, we'll just change out the microphone pad after the call.
Yeah.
A lot of people are saying you're running a full marathon in Las Vegas 2 weeks later.
Yeah, a month later. Yeah.
So Ben's just going to put up a casual, 50 miles over the next 2 weeks, and that doesn't include normal running.
So, and then I'm going to retire. I think I'll have achieved hopefully everything that I wanted to achieve in running. All right, but let's
enough about Ben. Let's talk about the market.
Let's jump into what happened yesterday, and really, it sounds trite, but it's as simple as rates going up and pricing in a little bit more of a hawkish Fed. A hawkish Fed, higher inflation, more sticky inflation. And Tom, I'm just going to read you some of the statistics, and then you can editorialize from there. So number one, since February 3rd, again, the market peak, we're currently at a target range of 4.5 to 4.75% for the Fed short-term rate. That's where we are today. The July expectation has gone from 1 hike to 3 hikes. The implied rate in July is up 51 basis points. The year-end implied rate is up 76 basis points to 5.16%. The 2-year is up 57 basis points. The 10-year is up 55 basis points. The 30-year benchmark rate from the Mortgage Bankers Association as of February 17th was up to 6.62%. That's the highest since November. And the real 10-year interest rate, the real inflation adjusted interest rate, is up from 0.89% to 1.43%. So this is not an inflation based move. This is a move wherein the market thought that the Fed would be less hawkish, and the Fed is turning out to be a little bit more hawkish, or at least that's how they want to guide the market. And that is the highest real interest rate since November 9th. And that's a major driver of stock market valuations. As we've talked about in the last few macro presentations, we've done some good historical work on that statistically. So Tom, with that as a backdrop, big time rate increases, big time real rate increases, how does that square as you think about what the Fed's going to do, but also especially as that relates to stocks?
I mean, obviously the valuations are going to drop, right? I mean, we talked about it a lot earlier in the year, which was that, our base case was always there were probably going to be 2 hikes, and then there was potentially a third, because that's what the Fed's been saying all along. And that I know I seemed like a bummer when the markets were up 8-9% 2 weeks into the year, but I say the risk is still the upside. The Fed is still actively saying 5.25% to 5.5%, and they won't stop saying it. But the market was indicating that we were going to get one more hike and then immediately start cutting in the summer. And basically the Fed called the market's bluff. They basically continued to say, we've got aces, and everyone's like, no, you don't have aces. You probably got 7-2 offsuit, and you're gonna have to fold, and we're all gonna be marching our way to lower rates towards the end of the year. But the fact
maybe you have a good runner like you have 10-9.
Yeah,
maybe suited.
You got a flush draw.
But you don't have anything right now.
Yeah, you don't have anything right now. But it turns out, they hit the flush on the flop, or they tripped up. So for those of you who don't play a lot of poker, which we used to around the office quite a bit, the Fed has basically been very open about what they've got. They've got a good hand, and they're going to continue to play it. And the more you bluff, the more money you're going to lose, right? If you keep putting money in trying to chase this hand, you're probably going to get burned. And so that's where we're at. I mean, the market was saying they thought one thing and the Fed was saying something else. And now the market has turned around and said, oh, yeah, it turns out the Fed's going to do this. They're going to raise rates. And so everything shifted accordingly. Expectations of inflation, expectations of long-term rates, expectations of valuations on stocks have gone down, because as rates go up, that negatively impacts the cash flows going forward. So that's where we're at. And we've seen a big repricing. And the stock market, not to sound dour, but the stock market is still up. The bond market is still up for the year. There's still unbelievable opportunities on the fixed income side. I mean, the longer we can go in this higher interest rate, the more bonds we have roll off, we can reinvest, the best it is for long term, especially retired clients. So it's not all bad news, but it has been a huge difference. I mean, we're fully priced in now on 3 hikes this year. We're at 2.996 for the next 3 subsequent Fed meetings. According to futures markets, we're basically 100% guaranteed to get 3 rate hikes, which has really been what the Fed has messaged all along. The third one was always kind of a question mark. We kind of always had it penciled in as 50-50, and now it's basically, the coin's flipped, it's come up heads, and we're going to get a third hike, assuming the data doesn't change drastically in the next 3 months.
I think that's a big caveat. And the way that this plays through to stock market valuations, looking back historically, especially over the last year and a half or so, and I think because this is the second time we're going through this, I think that it's having a less of an impact. But given where we have seen real interest rates go over the last 3 weeks, I would have actually expected the market to fall about 8%. That's just the algorithm. Instead, the market's down about 4%. So, from that point of view, I think that that's a little bit positive. Today's stocks are up a little bit pre-market. So we'll see what happens with that going forward. I think that you do have a big offset in that the economy has remained a little bit more resilient. So although you would normally expect those valuations to drop, the valuation of the stocks are actually holding in reasonably well because the economy is stronger. Now, because the economy is stronger, we're also pricing in more rate hikes. So it's kind of the circular notion right now. But, as we go forward over the next few months, if inflation can come down a little bit and make sure that we stop out here at these three rate hikes, then I think that you could have some more upward mobility in what the in the stock market valuations. Okay, so switching gears to the minutes today, Jim Bullard was on CNBC this morning, and he talked about inflation, growth, interest rates, and he didn't really change his tune. Basically, he said that he thought that the rate should be 5.375%, and he still thinks the rate should be 5.375%. The difference between now and 3 weeks ago is that 3 weeks ago, the market was pricing in 4.4%. Now the market's pricing in 5.375%. So as we look toward the minutes that get announced later today at 2 p.m., even if the Fed is in Bullard's camp, I would think the market should be priced for that. And so I would say that the balance of risks today for stocks today is to the upside, not tomorrow. Who knows? But today, I think that we're pricing in a lot of hawkishness from the Fed. Tom, your thoughts?
Yeah, I think we're at max hawkishness now. We've taken everything they've said and we price it in. So anything that is said in February, even if part of the minutes is like, hey, some people were in favor of 50 basis points, we're all in favor of quarter points from now on, that may actually be a positive read for the market because there are no surprises because we know what they've said. We've now locked in that as the base case for the whole market. And so there's not going to be, if anything, there's more room for dovish surprise. And one thing that he said this morning, which that has moved futures quite a bit, basically from the moment he said it, is that he thinks the market is overpricing in the likelihood of a recession this year. I think we are definitely in that camp as well, just given the strength we've seen so far in a lot of the economic data. And that set the market up. I mean, we were basically up 40 basis points on futures from that moment. I mean, it just ticked up pretty aggressively after that. And I mean, I think Bullard is an interesting character. There one question they asked him if he calls up Jay Powell and says, hey, I'm about to go on CNBC and talk. Do you do that? Does Jay Powell push back on that? He basically says, yeah, we don't do that. I just do what I want, which was kind of interesting. So important to remember, one, he doesn't vote. Two, he says whatever he wants and without Jay Powell giving his blessing. Whether or not that's 100% true, I'm not really certain, but I'm assuming if I was on TV, I'd want to say Ben, and Andrew didn't send me in here to say this, I'd be like, I'm my own man. But I think there's a little bit of embedded messaging in there for Jim Bullard from the Fed. if not explicitly so. It's implied, I think. But yeah, basically the message is we're going higher. We're probably going at least 3 rate hikes higher, if not more. The economy is very strong. That's the reason. And he also said that he doesn't believe in the Phillips curve, which is basically a concept that inflation and employment have a very strong inverse relationship, which is if inflation is up, employment should be going down, and vice versa. Because, as there are fewer and fewer jobs, you got to pay more and more that goes up. The more people are in demand, prices go up. Basically just is a supply demand function. He basically said that he thinks that we can continue to raise rates, and that is not going to be as effective on employment and bringing it down as much as people think. He also said
basically he's not. Yeah. So he's not concerned with he's not concerned with the negative impacts as much as the market would be.
Yeah.
And he said that with the Phillips curve, he said that with the recession risk.
Yeah. And that's played out. I mean, we were ringing the alarm bells last summer thinking, man, if they start raising rates by 75 basis points, we're going to see just a bloodbath in the jobs market. And we really haven't seen that outside of tech. And he said specifically that he didn't think that tech was a good indicator of the overall employment picture, which I think is true. I think we've seen anecdotally either through, people posting on social media or, basically reports that come out that these tech companies, as a result of all the COVID money, all the low interest rates, were just excessively bloated, just, full teams of people whose job was to, monitor other teams whose job was to monitor other teams. I mean, just stacks and stacks and stacks of people at Google and Facebook and, Twitter. I mean, they cut basically the entire staff and it's still going.
The interesting thing on the tech side, just kind of as an aside, we were talking about this last night, is what is the effect of hiring freezes? Because I think that people think that the first, obviously, the top line of thinking is that you have a hiring freeze, you're going to get lower employment. But if you're going on to some of these employee blogs, some of them are saying, well, I could get more money working someplace else. I could, but I don't want to just quit, because if I quit, I don't get severance. So I want to get laid off. But the problem is, if you're working for a middle manager, that middle manager doesn't want to lay you off, because then that's more work for him, or it shows that he doesn't really do anything.
Yeah.
So if there's a hiring freeze, you have an incentive to have a firing freeze, almost. Now, I know that there's been corporate layoffs at Amazon, Microsoft, and all these places, and I get that. But it's something interesting to think about. Maybe you have that. Maybe you have a slower level of normal attrition than you might have in a different market.
Yeah, because theoretically, if you freeze hiring, you're not adding people, but you, in theory, are adding revenue, growth, new opportunities. So you'd think that you could grow into, you could eat up the capacity of people you do have before hiring more people, rather than saying, we're going to start cutting people and then you don't have enough capacity for any potential growth.
Right.
So everybody becomes a little more sticky, and everyone then, of course, that does want to stay has to, basically prove that they're there for a reason. So if you're a middle manager, you want to have 5 reports because that makes you important. If you have to fire 1 or 2, or even your whole team, then you're
not allowed to replace them.
Yeah. What's the point of view if you don't manage anybody? You just become another expendable person.
So something to think about for sure. All right. Let's talk a little bit about companies. Because we were talking about mortgage rates earlier, we'll start with Toll Brothers. Toll Brothers has actually seen a marked increase in demand beyond normal seasonality, as buyer confidence appears to be improving. So they gave a very bullish report. I just wonder when they wrote this press release, because as of February 17th, according to the Mortgage Bankers Association of America, U.S. home purchase applications dropped to a 28-year low. So,
well, technically they're reporting on the fourth quarter, so it's not lying, because theoretically demand could have dropped off a cliff January 1st, but they don't have to address that, because what they are addressing is what sales were like in the last 3 months of 2022, which were probably higher as expectations for inflation dropped and rates dropped, so they can, it's a lie of omission as opposed to a blatant lie.
It's a very volatile market, and things change quickly, and drawing long-term conclusions from short-term moves in interest rates is probably folly. Winter storms ground more flights. Again, Southwest is getting hit by that. 196 flights grounded for Southwest. That's more than Delta, who has canceled 139 flights. It started in California. It's now in the Twin Cities. It is moving toward the Northeast. So that's the storm. And it's causing more concern in the airlines. And I think airlines have been such a hot button idea for people because they see that where airline prices are going, where fares are going, and just say, man, it's so obvious that we need to be buying airlines. But the problem is you have probably peak pricing in terms of year over year growth. And you have these operational issues, which are difficult to reconcile when you're growing quickly, when you're rebounding. So airlines are a tough place to be in. They've always have been, and they probably always will be.
I mean, I've said it a million times on this call, going all the way back to 2020, but there are two types of airlines: those that have gone bankrupt and those that will. I mean, just you look at the graveyard of the history of airlines, and they all go bankrupt because it's like choosing between bottles of water. You know, you choose the cheapest one, and if one's slightly cheaper, then the other one goes out of business.
Yep. Two last stories, Intel and TJX. TJX is, of course, the parent of TJ Maxx and Marshalls and Home Goods. They also own the Christmas tree shops, or at least at one point they did. Anyway, TJX missed its guidance for the year primarily as a result of shrinkage. They're having a lot more theft. They would have really crushed results for the quarter. The actual sales were very strong, but they had increased theft, which really reduced their margins, and that's expected to continue over the next year. So it was a decent quarter, and when I first saw it, I was a little bit surprised that the stock was up. Now the stock has gone down, which I think is probably appropriate. Inventory is in a relatively good spot. It's down year over year by about 3%, but their margins are very weak, 10% in a year where they should be able to buy a ton of inventory at very cheap prices, because they're basically taking all the inventory that the department stores don't want. But they don't seem to be executing on that very well. So TJX is down now. Intel is also down, although I'm very curious to see how this one trades. Intel cut its dividend by about 2/3. It's now 50 cents a year, down from $1.46. But they did affirm their first quarter guidance. So that is good news, because I feel like with Intel, it's been just, I would say, paper cut after paper cut, but it's really gash after gash after gash after gash. Maybe they've stemmed the tide, or at least they're trying to make the argument that they have. They say the decision to decrease the quarterly dividend reflects the board's deliberate approach to capital allocation and is designed to best position the company to create long-term value. I think it's an overdue, much-needed move. It's also a warning sign. Don't just chase the dividend yield, because that might not always be there. But I wouldn't be surprised to see Intel stock go up on this.
Yeah, I mean, they're down to bare bones, right? It's either clean up your act or die, right? And they're a dinosaur. They're one of the original tech companies, and they've just been bleeding out for years. The question is this going to be the turnaround point? Are they going to be a success story, or is this eventually going to be, they trade down to a super low valuation, somebody comes in, buys them, breaks them up, takes what they want, and then just throws the rest in the trash? I sort of am leaning the latter, to be honest. I think that 15 years from now, Intel is eaten up by Microsoft or somebody. They've taken in whatever pieces they want. And it just doesn't exist anymore.
On that happy note, we will leave it there, and we'll see you tomorrow morning. Thank you.